John C. Bogle, the founder of Vanguard and creator of the first index fund, was a titan in the investment world. His innovative ideas and dedication to investor education have left an indelible mark on the financial industry. He championed a simple yet powerful approach to investing: low-cost index funds. This approach revolutionized the way people think about investing, making it more accessible and cost-effective for the average person. Bogle believed that rather than trying to beat the market, investors should aim to match it. This philosophy was grounded in the idea that the market's overall performance is difficult to surpass consistently. His book, The Little Book of Common Sense Investing, distills this philosophy into an accessible guide for everyone. It breaks down complex financial concepts into easy-to-understand language, making it a valuable resource for both novice and experienced investors. This book is a must-read for anyone who wants to build wealth over the long term. It provides practical advice and insights that can help investors make informed decisions and avoid common pitfalls. Bogle's central argument is that investing doesn't have to be complicated. He believed that simplicity is the key to successful investing, and that anyone can achieve financial success by following a straightforward strategy. In fact, he argued that simplicity often leads to better results. By avoiding the complexities and high costs associated with active management, investors can achieve more consistent and reliable returns. He believed that by investing in a low-cost index fund that tracks a broad market index, such as the S&P 500, investors could capture the market's return without the high fees and risks associated with actively managed funds. This approach democratized investing, allowing more people to benefit from the growth of the market. This approach, known as passive investing, is in stark contrast to active investing, where fund managers try to pick stocks they believe will outperform the market. Passive investing removes the guesswork and focuses on long-term growth. Bogle argued that the vast majority of active managers fail to beat the market over the long term, and even when they do, their high fees eat into investor returns. This makes passive investing a more attractive option for most people. He famously said, "The math is compelling. Gross return in the market, less the costs of the croupiers, equals the net return shareowners actually receive." This simple equation highlights the importance of minimizing costs to maximize returns. Throughout his book, Bogle uses compelling evidence and straightforward language to dismantle the myths surrounding active investing and make a strong case for the simplicity and effectiveness of index funds. His arguments are backed by decades of research and real-world experience. He emphasizes the importance of minimizing costs, understanding market efficiency, and maintaining a long-term investment perspective. These principles are the foundation of successful investing and can help investors achieve their financial goals. By following Bogle's common sense principles, investors can build wealth steadily and achieve their financial goals. His legacy continues to inspire and guide investors around the world, proving that simplicity and discipline are the keys to financial success. Index funds are like mirrors reflecting the entire market, capturing the collective performance of all the companies within that market. When you buy an index fund, you are essentially buying a tiny piece of all the companies included in that index, giving you a slice of the market's overall performance. For example, if you invest in an S&P 500 index fund, you own a small fraction of each of the 500 largest publicly traded companies in the United States, from tech giants to retail behemoths. This diversification is key to mitigating risk, as it spreads your investment across a wide array of companies and sectors. Index funds are designed to track the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average, by replicating their composition. They do this by holding the same stocks in the same proportions as the index, ensuring that the fund's performance closely matches that of the index. This passive approach to investing has several advantages over active management, which involves frequent buying and selling of stocks. First, index funds have much lower fees than actively managed funds, as they require less hands-on management. Active fund managers charge high fees for their stock-picking expertise, which can significantly eat into your returns. However, as Bogle points out, the vast majority of active managers fail to outperform their benchmark indexes after accounting for fees, making their high costs hard to justify. This underperformance is a significant drag on investor returns, reducing the overall growth of your investment. Second, index funds benefit from the power of compounding, which can significantly enhance your investment over the long term. Compounding is the snowball effect of earning returns on your returns, leading to exponential growth over time. Over time, even small differences in fees can make a huge difference in your portfolio's growth, as lower fees mean more money stays invested and compounds. By minimizing fees with index funds, investors keep more of their returns, allowing their wealth to compound faster and more effectively. Finally, index funds offer investors broad market exposure and diversification, which are crucial for a balanced investment strategy. By holding a diversified basket of stocks, index funds reduce the impact of any single stock's performance on the overall portfolio, providing a smoother investment journey. This diversification helps to mitigate risk and smooth out returns over time, making index funds a reliable choice for long-term investors. In investing, costs are like termites, silently eating away at your returns. Every dollar you pay in fees is a dollar less that compounds for you over time. Bogle stresses that minimizing costs is one of the most important factors in achieving long-term investment success. There are several types of investment costs, including expense ratios, trading commissions, and taxes. Expense ratios are annual fees charged by mutual funds and exchange-traded funds, ETFs, to cover their operating expenses. Trading commissions are fees charged by brokers for buying and selling securities. Taxes are levied on capital gains and dividends earned from investments. Bogle argues that trying to beat the market is a fool's errand. He presents compelling evidence that the vast majority of active fund managers fail to outperform their benchmark indexes over the long term. Even when they do outperform, it is often due to luck rather than skill. Active management is based on the belief that skilled fund managers can consistently identify undervalued stocks and time the market to generate higher returns than the market average. However, this belief is not supported by historical data. Numerous studies have shown that active managers, as a group, underperform their benchmarks after fees. Section 5. Embracing market efficiency: why stock picking is a losing game. Bogle was a strong proponent of the efficient market hypothesis, which states that stock prices reflect all available information. This means that it is virtually impossible to consistently predict which stocks will outperform or underperform the market. Market efficiency implies that stock prices move randomly, and that any information that could potentially impact a stock's price is already reflected in its current price. This makes it extremely difficult for even the most skilled investors to consistently identify mispriced stocks and generate market-beating returns. Section 6. Patience is a virtue: the long-term investor. Bogle stresses the importance of patience in investing. He argues that investing is a marathon, not a sprint. Investors who chase short-term gains or panic during market downturns are likely to make poor decisions that hurt their long-term returns. Section 7. Time in the market, not timing the market. Avoid trying to predict. Market timing, the practice of trying to predict when to buy and sell stocks, is another losing game according to Bogle. He argues that investors who try to time the market are more likely to miss out on market rallies and buy high and sell low. Section 8. Bogle's Wisdom: Practical Tips for Building Wealth. Bogle offers readers several practical tips for building wealth through index fund investing. First, focus on index funds that track broad market indexes like the S&P 500 or the total stock market index. Second, avoid complex investment strategies and stick to a simple, low-cost portfolio of index funds. Third, don't be tempted to chase past performance or jump from one hot investment to another. Fourth, tune out the noise of the market and focus on your long-term financial goals. And finally, reinvesting dividends allows you to buy more shares and benefit from the power of compounding. Section 9. The Beauty of Simplicity. Keep it simple, stupid, or KISS. Bogle's investment philosophy can be summed up in this acronym, KISS. He believed that complexity in investing often leads to higher costs, increased risk, and lower returns. By keeping your investment strategy simple and focused on low-cost index funds, you can reduce your risk, minimize costs, and increase your chances of achieving your financial goals. Section 10. Stay the course: resisting the urge to chase performance. One of the most important lessons in Bogle's book is the need to stay the course and remain steadfast in your investment strategy. He emphasizes that investing is a long-term game, and that investors should resist the urge to panic sell during market downturns or chase after the latest hot stocks that seem promising in the short term. Market fluctuations are a natural part of investing, and they should be expected. By staying disciplined and sticking to your long-term plan, you can avoid making emotional decisions that could harm your portfolio and derail your financial goals. Remember, time is your ally in investing, and by staying the course, you give your investments the opportunity to grow and compound over time, leading to potentially significant returns. Section 11 Conclusion: A Lifetime of Investing Wisdom. Bogle's The Little Book of Common Sense. Investing is a timeless classic that offers investors a roadmap to building wealth through low-cost index fund investing. By following Bogle's common sense principles, investors can harness the power of the market, minimize costs, and achieve their financial goals. In a world of complex financial products and ever-changing market conditions, Bogle's message of simplicity, discipline, and patience is more relevant than ever. His book is a must-read for anyone who wants to take control of their financial future and build a secure retirement.